Bitcoin just took a nosedive. It was a gut-wrenching drop of over 30% from its October peak, wiping out nearly $800 billion from Bitcoin's market cap and over $1 trillion from the entire crypto ecosystems. Millions of traders were liquidated, their accounts vaporized in a storm of forced selling that seemed like it would never end. The price plummeted from its October highs above $126,000, crashing to lows that briefly erased all of the year's gains. The fear in the market is real, you can feel it, and the mainstream media is already riding the arbitrary for this bull cycle. But while the headlines are screaming bear market, some of the on-chain data is telling a completely different story. A story that suggests this wasn't just a random market move. I mean, what if this wasn't just a crash? What if this was a shakeout, a violent, brutal, and perfectly timed shakeout designed to steal your coins right before the real surge begins? Today I'm going to show you the evidence that they don't want you to see. This is not financial advice, I'm not a financial advisor, this is for education and entertainment purpose only. Before we look under the hood on the on-chain data, we have to talk about the official story. You have to understand the narrative being pushed by the mainstream media because it's a crucial piece of the puzzle. If you want to understand how the market can get fooled, you first need to understand the bait. The story goes something like this. The November collapse was a perfect storm. First you have the macroeconomic environment. For months the market has been hanging on every word from the Federal Reserve, desperate for a clarity on interest rates. In November the Fed's mixed signals fueled a risk-off sentiment across all markets. As US Treasury yields rose, investors started pulling money out of so-called speculative assets, and Bitcoin, which has been trading like a high beta tech stock, was at the top of the list. This macro pressure set the stage for the second factor, a technical breakdown. For weeks, Bitcoin had been holding a critical support level around $92,000. Many traders saw this as the last line of defense. When the price finally broke below it, the floodgates opened. Automated trading algorithms programmed to sell on a break like that kicked into high gear. Stop loss orders were triggered all at once, creating a tidal wave of sell pressure that the market just couldn't handle. The third and most talked about factor was the institutional retreat. The spot Bitcoin ETFs, the darling of 2025, suddenly went cold. After months of record-breaking inflows that pushed the price to all-time highs, November saw a dramatic reversal. A record-breaking $3.79 billion was pulled from US spot Bitcoin ETFs in November, the worst month on record. BlackRock's IBIT, the largest of them all, saw billions in redemptions by itself. When the institutions you were told would secure Bitcoin's future start dumping, it's easy to feel a sense of dread. Rising yields, a technical breakdown, and institutional panic. It's a convincing story. It's a narrative that makes you feel like selling is the only smart move. It's clean, it's simple, and it might be exactly what the market manipulators were counting on you to believe. Because while all of that was happening on surface, something else was going on in the shadows. This is where things gets interesting. To see the real story, you have to ignore the noisy headlines and the panic on social media. You have to look at the blockchain itself, the unchangeable ledger that tracks every single transaction. And when you do, the perfect storm narrative starts to fall apart, replaced by a much cleaner picture of calculated accumulation. Let's start with those same institutions that were supposedly running for the exits. The ETF outflow number was indeed shocking, with a record of nearly $3.8 billion leaving in November. That's a scary headline, but headlines don't tell the whole story. While the month as a whole saw massive outflows, the day-to-day data shows fascinating swings. For example, after a huge outflow, there were often sharp reversals with hundreds of millions flowing back in on subsequent days. This isn't necessarily the behavior of institutions that are losing faith for good. Some analysts argue this is the mark of sophisticated players using volatility to their advantage, selling at one level and buying back lower to shake out weaker hands. Even more telling is what was happening away from the ETFs. While the media focused on outflows, on-chain data shows that a new wave of whales wallets holding lots of Bitcoin was quietly being born. Data from analytics firms Sentiment revealed that starting right in the middle of the crash on November 11th, the number of wallets holding 100 Bitcoin or more began to rise. In fact, 91 new whale entities emerged during this period of extreme fear. Let me say that again, while you were being told that everyone was selling, some of the wealthiest players in the market were actually increasing their positions, scooping up coins from the panic sellers. This looks like the classic you versus them scenario playing out in real time. They, the whales and institutions with deep pockets, can create panic with their immense capital, driving prices down. Then they use that panic to buy up the supply from us, the retail investors who get scared out of their positions. And where did that Bitcoin go? It didn't just sit on exchanges waiting to be sold again. One of the most bullish signals is the amount of Bitcoin held on exchanges. Throughout the November crash, a significant amount of Bitcoin was being withdrawn from exchanges and moved into cold storages. This is a classic sign of long-term holders who have no intention of selling anytime soon. They are securing their coins for the long haul, taking them off the market and shrinking the available supply. When supply on exchanges is low and demand comes back, prices have nowhere to go but up. So while the official story was one of institutional retreat, on-chain data paints a picture of possible institutional rotation, whale accumulation, and a massive supply shock in the making. They weren't running from the fire, they were collecting the assets being thrown out of the burning house. This might not be a bear market signal at all. It could be the groundwork being laid out for the next explosive move higher. So how could they pull it off? Well, how could they orchestrate a market drop that liquidated millions of traders and let them scoop up coins at a huge discount? It likely wasn't random. It often follows a precise 3-step playbook. This is the anatomy of a potential shakeout. The first step in any major shakeout is to provide the fuel. In crypto, the fuel is leverage. For months leading up to the drop, the market was encouraged to be wildly bullish. Prices were pushed to new all-time highs above $126,000, creating a feeling of euphoria and intense FOMO. During this time, futures and derivative platforms made it incredibly easy for traders to take on huge amount of leverage. The market became a tinderbox saturated with greed. A massive $19 billion liquidation wave in October already showed how fragile the system was. That event was just a warning. By November, the market was dangerously over-leveraged, with most traders betting on the price only going up. The bonfire was built and it just needed a spark. This is the main event. The goal here isn't just to push the price down, but to trigger a self-reinforcing death spiral, what's known as a liquidation cascade. It starts with a trigger. This could be a coordinated dump on spot exchanges or exploiting market weaknesses. When the initial dump pushes the price below a key psychological level like the $92,000 support, it triggers the first wave of liquidations. This forced selling adds more supply to the market, pushing the price down even further and faster. This in turn triggers the next wave of liquidations at a slightly lower price. It's a brutal automated feedback loop. At the same time, the manipulators, large market makers, and algorithm funds can do something critical. They pull their liquidity, they remove their buy orders. This creates a liquidity vacuum. In this environment, even a small sell order can cause a massive price drop, speeding up the cascade even more. During the peak of the November panic, liquidations reached a staggering $2.2 billion in a single 24-hour period. It's a storm of forced selling into an empty order book, and it's designed to create maximum fear and damage. The final step is the quiet accumulation. After the cascade does its work, the market is in a state of extreme fear. Retail traders, seeing their portfolios get crushed, finally give up and sell whatever they have left just to make the pain stop. The media is filled with stories of a new crypto winter. This is exactly what the big players want. In this news vacuum where all the information is negative, they can step back in. Having withdrawn their liquidity to help cause the crash, they now begin placing their buy orders again, but at much lower prices. They become the buyers of last resort, calmly absorbing the panic selling from terrified investors. And this is where the on-chain data is so important. While the world was panicking, the blockchain showed us exactly what was happening. Whales were adding to the holding and coins were flying off exchanges in the cold storages. They may have created the panic and then they bought the panic. This 3-step process is a classic playbook. It's designed to transfer wealth from the impatient to the patient. By understanding this playbook, you can go from being the victim to being the observer. So what does this all mean for you? Well, it means that the brutal crash you just saw might not be the end of the bull run. The on-chain evidence is compelling. This may not have been a fundamental shift in the market's direction, but instead a structural mechanical deleveraging event, a planned, violent, and efficient shakeout designed to clean the market of excess leverage and, more importantly, to transfer Bitcoin from weak, fearful hands to strong, patient ones. The smart money may have played its hand. They might have used the macroeconomic uncertainty and the fragility of an over-leveraged market to engineer a panic. They could have created a firestorm of liquidations to force prices down and then stepped in to buy your Bitcoin at a discount. I mean, the data doesn't lie. While many are selling in terror, they were accumulating in silence. The pain is real, the fear is justified, but understanding the game is the first step to winning it. The feeling of being outmaneuvered ends now. You're no longer just a participant, you are an observer of the mechanics behind the market. You know the playbook. You know that extreme fear is often a signal of maximum opportunity. You know that conviction is your greatest weapon against manipulation. They've washed out the leverage, they've filled the bags, the weak hands have been shaken out, the stage is now set asset for a market with a much healthier structure where supply is constrained and held by those with a long-term vision. They may have needed to get you out before the real move begins. The final shakeout could be over. The deck has been cleared. Now the question is what happens next. With the leverage gone and smart money loaded up, where does Bitcoin go from here? Let me know your price target for the coming surge in the comments below. And if you want to stay ahead of the next big market move, make sure you subscribe and hit that notification bell.